All right, let's dive into something that, on the surface, seems like a total contradiction. We're talking about the wild, volatile world of Bitcoin and how its explosive growth is secretly tied to something called a stablecoin. It sounds kind of crazy, right? But you're about to see how one has become the essential fuel for the other.
I mean, think about it. On one side, you've got Bitcoin. You know the deal. Its price goes on a total roller coaster, making headlines for these massive swings. And on the other side, you have stablecoins, which are built from the ground up to do the exact opposite. Their whole job is to be stable, usually pegged to a single US dollar.
So, what gives? How could these two polar opposites actually be partners? How can a token that's designed to be boring and stable be the main driver behind the world's most famously volatile asset? Well, that's the puzzle we're going to unpack right now. To really get this relationship, we first have to be clear on what a stablecoin even is. The best way to think about it? It's like the crypto world's safe harbor, a calm place to dock when the financial seas get stormy. Okay, so here's the simple definition. A stablecoin is basically a digital version of a dollar that lives on a blockchain. Unlike Bitcoin, its goal isn't to shoot to the moon and gain value. Its entire purpose is just to hold its value, staying right around $1. And it's that stability that makes it so incredibly useful. So, how do they pull that off? It's actually pretty straightforward. A company, the issuer, takes in real-world money, like your US dollars, and keeps it safe in a reserve. Then, for every real dollar they hold, they issue one digital token. That one-to-one backing is the secret sauce. It's the bridge that connects old-school banking with the non-stop 24/7 world of crypto. Okay, now that we're on the same page about stablecoins, we can get to the really juicy part. Let's break down the three key ways that they act as the secret engine pushing Bitcoin's growth. These three roles all work together. First, you've got the on-ramp. Stablecoins are the #1 way that new money gets from a traditional bank account into the crypto ecosystem. Second, they're the trading pair. Once that money's in, it's the main currency people use to actually buy and sell Bitcoin. And finally, there's the safety net. When traders make a profit, they can swap their Bitcoin for stablecoins to lock in those gains without having to cash all the way out of the market.
Now, this tight relationship creates a really powerful pattern, one that market analysts watch like a hawk. When you see a huge spike in the creation of new stablecoins,
You'll often see Bitcoin's price start to climb right after. That's that on-ramp function we just talked about, playing out in real time. A flood of new stablecoins is a signal that there's a giant pile of cash just sitting on the sidelines, getting ready to be invested. And more often than not, its first stop is Bitcoin. And hey, this isn't just a hunch. As one industry study put it, a jump in the stablecoin supply is a huge flag that big institutional investors are getting ready to buy Bitcoin. It's become one of the most reliable leading indicators for where the market might be heading. And the scale of this is, well, it's just staggering. Get this, 80%. That's the percentage of all crypto trading today that's done using stablecoins. Just a few years ago, that number was under 20%. Bitcoin's entire market is now basically running on a stablecoin-powered backbone. And believe it or not, this partnership is about to get even tighter. You see, for years, stablecoins were kind of in a regulatory gray zone. But that's all changing, thanks to some game-changing new rules that are bringing a whole new level of trust to the space. In 2025, the U.S. government passed what's known as the Genius Act. This was the first major piece of legislation to put formal rules around stablecoins. It basically says issuers have to be fully backed by real assets, and they have to prove it with regular audits. The whole point is to build trust and make them safer. So you might be asking, how does regulating stablecoins help Bitcoin? Well, it's a domino effect. More trust in stablecoins means more people, and more importantly, huge companies feel safe moving money onto that crypto on-ramp. The ramp just got bigger, wider, and safer for everyone. And when new people show up to the party, what's the first asset they almost always look to buy? Yep, Bitcoin. And the potential here is just massive. The U.S. Treasury Secretary himself projected that the stablecoin market could balloon to almost $4 trillion by 2030, saying that this new regulation is only going to speed things up. So where does this all leave us? Well, we could be looking at a $1 trillion takeoff. And it's all being powered by this very unique, very powerful partnership between stability and volatility. Let that number sink in for a second. $3.7 trillion. That's not just a big number. That represents a massive ocean of liquid digital cash that can flow into an asset like Bitcoin instantly, any time of day, any day of the week, with no bank holidays. It's a fundamental change to the plumbing of global finance.
And that really brings us to the bottom line. These two aren't enemies, they're a team. Stablecoins provide the on-ramps, the trading liquidity, and the safety net that allows the Bitcoin market to grow and mature. So in this new world of digital finance, it turns out that what's good for stablecoins is proving to be great for Bitcoin.
All of this leaves us with one final, incredible question. If we've established that stablecoins are the engine, the infrastructure, and the fuel, then as that fuel supply grows into the trillions, just how high can Bitcoin fly? That's the question the entire market is waiting to see answered.